The first key point I want to make is on consolidations. My name is Francis Braganza. I hope I will have you as a student as we do our interactive course together, my videos, etc. People are passing just listening to them, so if you join us, it'll be great. So there we are. Here are some key points from me to you. With regard to consolidations, I use something called the net assets method. Now, what you have to realize is when you prepare the net assets, the list of net assets, the net assets are basically the share capital and reserves of the subsidiary. So you'll have one column for the date of acquisition when you buy the shares in the subsidiary, and another column for the consolidation date. So when you bring in your share capital and reserves, the share capital will not change. So if the reserves changes, which of course it will between acquisition and consolidation, and of course all the fair value adjustments change, because remember when you acquire a subsidiary, you've got to do fair value adjustments and something called provision for unrealized profit, PUPs, things like that. So if you have net assets at acquisition, which is share capital plus reserves and adjustments, and at consolidation date, you also have the same share capital plus different reserves plus different adjustments. If you take the total of the acquisition net assets and the consolidation net assets, because the share capital remains the same, any change in reserves and adjustments will be reflected if you just take the totals, the difference in the totals. Let me show you what I mean by this. So if you have the subsidiaries' net assets at acquisition and at consolidation, and the share capital is 100,000, and that has to be 100,000 there as well. Then you have reserves of 50, which becomes 70. Then you have your fair value adjustments and bits and pieces that total up to, say, 20. And here, I don't know, 30 perhaps. If you now add up the left-hand side, that is 170, you see. And if you add up this side, that's 200. So what I'm saying is, if you take the difference between the 170 and the 200, just write that a bit more neatly, so sorry. If you take the difference between the 170 and the 200, that is clearly the difference between the reserves and the fair values. So by taking the change in the net assets, you're actually taking the change in the reserves plus all the adjustments, because as you can see, the share capital remains the same.